Welcome back, everyone. It's Finance Friday, another special edition of Money Girl where I answer your burning money questions. Today's question is from Ivy, who says, "Hi, Laura. I'm happy I started listening last year and have learned a lot. An insurance agent wants me to buy an indexed universal life insurance policy. She suggested I use it for my child's college expenses instead of a 529 plan, but I feel uneasy about it. What do you think about who should buy cash value life insurance?" Thank you for your question, Ivy. Life insurance, when properly used, is an incredibly versatile financial product. However, I think there's so much confusion about it because there are lots of different types of life insurance, and there are lots of subcategories of those types of policies, and there are add-ons that you can choose to put onto policies for even more benefits. So when you kind of add all that up, life insurance can be a pretty confusing and I think often misunderstood type of financial product. Plus, life insurance agents do get paid a commission. And, there's nothing wrong with that. They are working in their field just like any other professional. So you do have to be wary of getting sold a product that you may not need. This podcast will answer Ivy's question by reviewing ways to use cash value life insurance to protect your loved ones and provide growth and income when it's suitable for your financial situation. I want to welcome you back and thank you for joining me. I'm Laura Adams, an award-winning personal finance author, money speaker, founder of the Money Stack newsletter, and host of this podcast, Money Girl, with 43 million downloads. If you're not already subscribed to the show, please do that. That's the best way to make sure you never miss an episode. We are now doing 2 shows a week, Wednesdays and Fridays. Fridays is our Q&A format. So if you have a question you'd like me to cover, I would love to hear it. All you have to do is call 302-364-0308 and just leave me a voice message. Or if you prefer sending an email, that's great as well. You can do that using my contact page at lauradadams.com. That's also where you can sign up for The Money Stack, my free newsletter that goes out 3 or 4 times a month with all kinds of money tips, news, advice, fun things that I'm into, and a lot of educational and inspiring information that I hope will help you up-level your personal finances. So first, let's talk about the primary types of life insurance. There are several types of life insurance, as I mentioned, but if you really want to boil it down, you can divide them into 2 main categories. The first is temporary, called term life, and permanent. So we're going to talk a little bit about each of these, and then I'll explain more about, how to answer Ivy's question. So term life insures your life for a specified period. It could be 5 years, 10, 20 years. If you pay the fixed annual premium and you die within the term, so if you get a 20-year policy and you die in year 19 of that policy, your beneficiaries will receive a guaranteed death benefit. So it's, very useful if maybe you just need insurance for a period, like you want to make sure you get your kids through college so that they're out on their own and independent. You maybe would get a 20-year policy if they're young. But this is something that is, I'd say, the most popular type of coverage because it's quite affordable. So for instance, let's say you purchase a 20-year, $500,000 term policy with your spouse as the beneficiary. If you were to die before the policy expires, your spouse would receive that full amount of $500,000 as a lump sum payment. And it is relatively inexpensive, especially if you're young and healthy. For example, if you're in your 30s, a 20-year, $500,000 term life policy might only cost you a couple $100 a year. That's quite a bargain. But if you're older, let's say you're in your 50s, that same policy, 20-year for $500,000, might cost several $1,000s a year, depending on your health. So the older and the less healthy you are, the higher your life insurance premiums are going to be. And this is the case for both term and permanent. And so we'll talk about permanent now. That's the other main type of category. And it's called permanent because it covers you no matter when you die. A lot of the policies will specify an age. It could be 100, 105, some even go higher than that. So it is more expensive than a term policy because it's covering you no matter when you die. It's also more complex and it has subcategories that I'm going to explain. So in addition to paying a death benefit to your beneficiaries, a permanent life policy is also a financial investment. So generally, a portion of each of your premium payments goes into an investment account that builds cash value. And this happens on a tax-deferred basis. So this investment portion of a permanent policy is the complicated part. The other part of it, the death benefit, is pretty simple. That's kind of like the term piece. Your beneficiary or beneficiaries would get the payout that you stipulate. But let's break it down a little further so you understand the three main types of cash value life insurance. So they are whole, universal, and variable. And each type does give you that tax-free death benefit no matter when you die. And it has a tax-deferred cash accumulation that's happening inside the policy. But the policies differ in how that cash value is generated, how it's growing, kind of what's behind the scenes there is why these three types of policies are different. So let's explain them. So the first, the whole life insurance. It provides a death benefit and a guaranteed return on your cash value. So it's the most straightforward type of permanent coverage, but it's also the most expensive because it comes with virtually no risk to the policyholder. You pay a level premium that is contractually guaranteed never to change. So you know what you're paying in and you know what that guaranteed return on your cash value is going to be. The second main type of cash value life insurance is called universal life. This provides a return on your cash value that's tied to a financial index or even just set by the insurance company. It is not directly invested in the stock market, but it is just based on what's going on in the stock market. It could be based on an index like the S&P 500. It typically pays a guaranteed minimum interest rate, so you're going to get at least, so much money, but it also has a similar downside protection called a floor. So you know that you can never earn less than a certain amount. So your premiums with this type of policy are actually flexible. So you can put more in as you like, and you may have the ability to, put in less or even some years put in nothing to the policy. And an indexed universal life or IUL, that's the product that Ivy asked about, and it's called an indexed universal because it is tied to a financial index, as I mentioned. All right, the third type of cash value life insurance is called variable life. This provides investment options like mutual funds that you select from a menu. And these are actual investments. These are actually in the stock market. So if they perform well, your cash value could rise far above what you could earn from a whole or a universal policy. But if they underperform, you could lose part of your cash value. So variable life has the largest growth potential, but it has the most market risk with no protection from loss. Like a universal policy, you can vary the amount of your premiums that you pay into the policy. So let's talk about how you purchase life insurance. When you apply for a term or a permanent life insurance policy, insurers use many factors to evaluate you and quote you a rate. The underwriting process varies by company, but they're trying to estimate how likely you are to die and when. And there are a lot of statisticians out there that know, pretty much down to the year when we're going to die, just simply based on statistics. statistics. So that's always why it's better to get life insurance as soon as you have a dependent, you have a child or a spouse that is dependent on your income, or, you know that you want coverage because younger applicants pay less. And you never know when your health could decline, and that could make you ineligible for life insurance or make a policy expensive and more unaffordable for you. Life insurers depend on mortality statistics, and they simply know that women tend to live longer than men. So that means women typically pay a little bit less for the exact same policy compared to men. Insurers also know that you could have inherited health risks. So they usually ask you about your immediate family members, their health, or their causes of death to evaluate your potential risk. And your lifestyle also significantly influences what you'll pay for life insurance. For instance, if you're a smoker, you're a heavy drinker, you use illegal drugs, or even have a history of drug use, or even being overweight, all of those increase your mortality, and so they also increase your life insurance rates. Another thing is what you do for work, like being in a high-risk occupation, like mining or flying planes. Having a dangerous occupation can also lead to higher premiums or even getting denied coverage. And the same for hobbies, like if you skydive quite frequently, or you go mountain climbing, all of those sorts of activities that put you at risk can cause your life insurance rates to increase. And there are other factors in life insurance rates that you may not expect, like your driving record. You pay more if you have a history of DUI, that's driving under the influence, or DWI, driving while intoxicated, or being in at-fault car accidents. Having that, that dangerous history in your driving record is something that insurance companies also look at. And traveling to high-risk countries, whether it's for vacation or for work, can also affect your insurability and your rate. Plus, many insurers consider your credit history as part of your overall risk profile. One benefit of permanent life insurance is that your cash value grows tax deferred. That allows you to skip paying taxes on investment gains that happen annually inside the policy. But if you withdraw cash, if it's allowed with the policy, the portion from your premiums that you withdraw is typically tax-free because they already were taxed. They get paid into the policy on an after-tax basis. But if you withdraw any of the investment earnings from your policy's cash value, that would be considered taxable income. Another interesting feature of some permanent life policies is being able to borrow from them or to take a tax-free loan against your cash value. However, taking withdrawal or loan does reduce the cash value, and it may also reduce the death benefit amount, especially, if you're not repaying that loan. An insurance loan could become taxable if you don't pay the policy premium, or let's say you surrender a policy for cash and it's got an outstanding loan on it. Similarly, surrendering a policy for more than the premiums that you paid in would trigger income taxes on any excess. So, there are some tax consequences there depending on how you plan to use the policy. However, the payout your beneficiaries receive from a term or a permanent policy after your death is typically not considered taxable income to them. So your heirs don't have to report their life insurance proceeds on their income taxes. So let's talk about some reasons why you might want to buy a cash value life insurance policy. Here are 7 reasons why having permanent life insurance could make sense. Number 1, you have lifetime dependents, like a disabled spouse or a disabled family member with special needs who can't earn an income, or they require ongoing financial support after your death. Number 2, you want your long-term care expenses covered through the ability to accelerate a death benefit, or having a hybrid policy that combines life insurance and long-term care insurance in one product. Number 3, you want to leave a financial legacy to heirs, to charities, or any institutions, no matter when you die. Number 4, You have a large estate and you want those life insurance proceeds to pay the estate taxes after your death. Number 5, you want final expenses covered, like your funeral costs and any debts, no matter when you die. Number 6, you have a high income and you've already maxed out your retirement account options, but you want to invest more on a tax-deferred basis to build a policy's cash value. And 7, you want to preserve other assets you own by being able to take policy loans for retirement income after a down market, giving your portfolio assets time to recover. So life insurance can be a big part of a retirement strategy. It's a bit advanced, but this is something that can really be there to diversify your retirement portfolio. And I'll talk a little bit more about that. So should you use cash value life insurance for college planning? That's what Ivy mentioned. She's obviously thinking about paying for her child's education, and she's wondering how an indexed universal life policy compares to a 529 college savings plan. So the benefits of a 529 plan do vary based on your home state. Ivy didn't mention where she lives. So Ivy, you want to compare them carefully. Make sure you really understand what are those benefits in the state where you live. In some cases, you may qualify for a tax deduction or a tax credit if you contribute to an in-state 529 plan that could really make it a lot more attractive. And parents, insurance salespeople may encourage you to move money to certain financial products, like an indexed universal life policy, to shield it from financial aid calculations to qualify for more federal aid or to cut your taxes. Now, I'm not saying that there aren't good situations for doing that. However, it needs to be part of a comprehensive financial plan. Therefore, to avoid being sold life insurance that you may not need, I want to encourage everyone listening, and I want to encourage Ivy to get a second opinion about it. Ivy, you ideally should meet with a financial advisor who can give you the pros and cons of investing for college using a cash value life policy versus a 529 plan. Remember that a life insurance salesperson isn't a financial planner. Even one who is excellent and well-meaning is not a financial planner. The bottom line is that an insurance salesperson doesn't get paid to review your financial situation holistically. They get paid to sell policies. So buying a cash value life policy may be an excellent choice. However, I want to recommend that Ivy hear that from an unbiased certified financial planner or CFP. You may also be wondering how much life insurance you should buy. Well, if you do get term life insurance through your employer, which a lot of people do, and it may be something like 1 or 2 times your salary, that may not be enough. You can buy additional term or permanent life insurance on your own. You can have multiple life insurance products. And remember that your life insurance typically ends on the last day of the month if you leave your job or you get terminated for any reason. A general rule of thumb is to buy life insurance with a death benefit at least 10 times your annual income. For instance, if you earn $100,000 and you've got a family and, you've got expenses and a home, you likely need at least $1 million in life insurance to protect yourself, particularly if you have young kids at home. Also, don't forget that the death of a stay-at-home parent would significantly affect the finances of most households. So that person who may not have an income but is caring for children, they need life insurance too. Ivy, the benefits of permanent life insurance go far beyond just a death benefit, which means I think it's worth considering. With an IUL, you can accumulate tax-deferred cash value and then take tax-free loans to pay future college expenses. However, any unpaid loans does reduce the cash value and the death benefit and could even have tax consequences depending on the amount that you need to take out of a policy to pay college bills. Cash value life insurance's downsides are that it's much more complex and more expensive than a term life policy. Plus, with an IUL, if the underlying market index performance is poor over a long period, your cash value may grow slowly or not at all, depending on the floor rate of the policy. Cash value life insurance, no matter what type we're talking about, whether it's whole, universal, or variable, these are designed for long-term financial planning, and they may be very unsuitable for short-term needs. So it can be an excellent tool for diversifying your financial portfolio, giving balance to your overall investment strategy. Due to its flexibility and growth potential, permanent life can help with estate planning, creating retirement income, and paying for a child's college. Ivy, I want to encourage you to keep asking questions and even to get guidance from a CFP about the pros and cons of an IUL and other types of college savings plans before deciding what is right for you. Since everyone's situation is different, cash value life insurance benefits depend on your finances, your family, and your protection needs. So I can't give you a yes or no answer about what is better, but the solution is definitely to do your homework, get second opinions, really research your options because, they depend on where you live, the type of policy that you buy, and your financial goals. So Ivy, I hope that has been helpful. I really appreciate you sending in the question. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and I want to thank our amazing team. We are audio engineered by Steve Rickyberg. Our director of podcast is Brandon Gaetschus. Our digital operations specialist is Holly Hutchins. Our advertising operations specialist is Morgan Christensen. And our marketing and publicity associate is Davina Tomlin.